Very good morning to all of you. In yesterday's session, we had covered in specific from section 80C to 80EEB. So that's what we discussed in last session with respect to chapter 6A. So we were speaking about various deductions. As we said, it's right from 80C to 80EEB for electric vehicles. In today's session, we are going to continue with that. So we are going to continue with the rest of the deductions, whatever is remaining in chapter 6A will be covered in this session. In that, one of the important section that we'll be covering today is ATG. So ATG is basically a donation. You can remember it as a gift, okay? So it is basically a contributing some for charity purposes, a donation. So that's what. So the first thing that we need to understand, who is an eligible assessee, that who can claim a particular deduction under section 80G. So when you say this, it's basically anyone who pays a donation, right? An assessee who pays a donation. So to whom shall they pay donation? Can they pay to anyone they wish, or is there any eligibility? Yes, they must donate to eligible funds or institution, which means there is an approval process. There is an approval process with respect to this particular concept. So only the funds which are approved, the eligible funds and institutions, are categorized under this ATG. So any donations made to such fund or institution is eligible for this deduction under section ATG. Now we are going to classify this into four categories. So basically, it is based on whether the particular donation category applies a criteria called qualifying limit. So we need to understand whether the particular transaction is without qualifying limit or with qualifying limit. So what is the condition? So does that particular transaction has a condition which relating to qualifying limit? So if there is no restriction on qualifying limit, then there is two categories, that is 100% and 50%. Again, if it is with qualifying limit also, you have 100% category and 50%. So we need to understand each of the donation category, that is the fund category in all these four buckets. So that is how we are going to understand. Now, as I've been telling this, one thing that will be running in everyone's mind is, what is this qualifying limit? So what is qualifying limit, right? So we need to understand that unless we know what is qualifying limit, what is the point in discussing about what is without, what is with, what is 100%, what is 50%? There is no point. So the most important thing as far as this is concerned is, what is qualifying limit? So qualifying limit is 10% of adjusted gross total income, right? 10% of adjusted gross total income. Now the next question, what's there in the mind? What is adjusted gross total income? So what is this? So what is adjusted gross total income? Let's understand that. So adjusted gross total income is typically the gross total income after reducing few things. The first thing that we're going to reduce is all chapter 6A deductions, other than this ATG. So if there are plenty of deductions, you have ATC, you have ATD, so reduce all that. But if you have ATG, ignore that. So anything other than ATG should be ignored. So when you say chapter 6A deductions is other than ATG. Other than ATG is what you need to reduce it from chapter 6A. So in this is basically other than ATG. Every other deductions other than ATG is what should be reduced. Now the next category is short-term capital gain under section 111A. So which means ATG for calculating this purposes, you remove that also, that is 111A. And then long-term capital gain under section 112 or 112A. So that is what is understood. And finally, no tax income, that is an income in which there is no tax at all. If it is eligible for complete, there is no taxability, that is 100% of the income is considered as not taxable or something, deductible or something. So basically, an income in which there is no tax. So if there is such income, that also needs to be ignored. So after adjusting all these, whatever you get is called as the gross total income, that is adjusted gross total income. So this adjusted GTI, 10% of this adjusted GTI is what you're going to call it as qualifying limit. So you're going to keep this as the limit. So wherever this comes, this area, you're going to apply that. You're going to apply that. For the rest of the thing, for this thing, there is no restriction. No restriction. So whatever it is, you either take 100% donation or you take 50% donation. So that's how you basically do. So we'll move on to the categories. We'll move on to the categories. That's we are going to understand each of the buckets. So we said with qualifying limit 100%, 50%. Without qualifying limit 100%, 50%. So we'll start with qualifying limit. Okay, we'll start with qualifying limit. We'll understand the 50% and then we'll understand the 100%. So what is with respect to 50%? Two types of charity. First is any fund established in India for charitable purposes. That is first category. Second category is basically a charitable purpose where the government or local authority for utilization of. So you are actually paying to a government or a local authority which is being utilized for a charitable purposes. Here there is an exclusion, that is charitable purpose other than family promotion, promoting family planning. So other than this, the others are concerned. The third one is basically relating to infrastructure. Infrastructure, that is your housing, accommodation, development of cities, development of towns, planning of cities and towns. All this is concerned in the third category. The fourth category is minority community, promoting the minority community. So that's what it is about. The last one is about religious institutions. Religious institutions which has historical importance. So these are the five categories. Okay. So we are going to see this. So as we said, you have charity. So you have charity, two types of charity, basis fund or institution, which is let's say approved. Okay. Approved fund or institution. That's the first category. The second category is what? Is to government or local authority. Government or local authority. Now in this government or local authority, what did we say? It is for the purpose other than family planning. So this is also for charity, but it is other than family planning. So you're paying to a government or local authority which is utilized for charitable purposes other than family planning. So that is what the charity is there. Then what did we say? We said housing accommodation. Housing accommodation. We'll call it as plus infrastructure. That is city planning and all those things. City planning, town planning, all those things. So housing accommodation plus infrastructure. So if any donation is made to such fund or institution for the purpose of housing accommodation or infrastructure, that is also allowed. The third one is promoting minority community. So promotion. So you're promoting minority community. That is the fourth category we are talking. The fifth category is religious places or historical places. What do? You see there is a huge palace which belonged to one of the ruler earlier. So a particular organization takes up this plan of renovating or repairing the whole palace. Now this whole palace, whatever is being repaired, there will be so much of cost involved. Any donation made for such renovation or repair work is eligible. So that is religious places. So these are the things that are covered here. So as we said, two types of charity. One is fund or institution established in India for charitable purpose. Another is the government or any local authority for utilization of charitable purpose other than promotion of family planning. The third one we said about you are donating to a particular institution which is into housing accommodation, which is satisfying the need for housing accommodation, promoting, that is for the purpose of development and improvement of cities, that is city planning. So these two things, that's also we said. And then we said it is relating to you are paying to any corporation established by the central government or state government for promoting of minority community. And finally, it is about renovation of repair of notified temple and other things. So these are the things that we're discussing about. And as with qualifying limit, so 50%. Now, what is with qualifying limit 100%? There are only two things. One is whatever is excluded here is included in 100% with qualifying limit. So it is included in 100%. So you pay to a government or local authority where the donation is utilized for promoting family planning. So that's the first thing. And the second one that we are talking about is encouraging sports. So you are paying to a company which is donating to Indian Olympic Association. So some paid by a company as donation to the Indian Olympic Association or institution established in India, and also includes for the infrastructure for sports or games or the sponsorship of sports and games. So it is basically whatever is being donated to these institutions, that is Olympic Sports Association or developing or promoting of sports. So for this reason, it is actually with qualifying limit. Okay. So these are the things that is actually covered. So these two things that we are talking about here is, that is 100% with qualifying limit. We are talking about what? Two things, right? Two things. One is promoting family planning. Promoting family planning is the first thing. And then you have Indian Olympic Association. Olympic Association. Development of sports. So that's one thing. So these are the things that are covered in 100% with qualifying limit. So now for these things, what you generally do is, we need to understand how is this computed, right? We need to understand how is this qualifying limit computed? How do you restrict this? So before getting into that, we'll first understand the other donations also. So now we have understood with qualifying limit, we need to understand what are the other donations available that are without qualifying limit, So what are they? So as far as this without qualifying limit is concerned, I'm going to tell you so many things. Now the immediate question that comes to your mind will be, how do I remember each one of them? There are around 25 donations if I'm right. So how do you actually remember each one of them? So it becomes difficult. So I'll tell you a way out after this particular slide. So I'll just take you through whatever is listed. You have National Defense Fund, Prime Minister's National Relief Fund, Armenian Fund, African Public Contribution, National Children Fund. Probably you can go through, right? You have Chief Minister's Earthquake Fund, and you have something called any Zilla Sakshrata Samiti constituted in any district for primary education. So how do you remember all this? So you have Army Central Welfare, Andhra Pradesh Chief Minister's Cyclone Relief Fund, and then you have National Illness Assistance Fund. So all this is what is covered. You also have a few more. So you have Chief Minister's Relief Fund, Lieutenant's Governor's Relief Fund, National Sports Fund, National Cultural Fund, and anything related to technology, National Trust for Autism, Cerebral Palsy. So all those things are there, right? Swachh Bharat Course, Clean Ganga Fund, and then you have National Fund of Control of Drug Abuse. Finally, you have Prime Minister's Citizen Assistant Relief in Emergency Situation. That is your PM CARE Fund, Citizen Assistant and Relief Fund. So that is what is called as CARES Fund. So that is with retrospective effect from 1st April 2020. Now, if you actually see, as I told you, there are too many, right? There are around 24 funds listed here. So it becomes very difficult to remember each one in this 24, of course, right? So rather, I would say we remember this alone. How do I remember this for? We all know Gandhi family, right? When I say Gandhi family, they are Jawaharlal Nehru, Indira Gandhi, Rajiv Gandhi. These are three prominent persons that India knows. So this family, that is Jawaharlal Nehru, Indira Gandhi, Rajiv Gandhi. So fund attached to them. You need not even remember what fund, because there is only one Jawaharlal Nehru Fund, that is Jawaharlal Nehru Memorial Fund. There is only one Indira Gandhi Fund, that is Indira Gandhi Memorial Trust. There is only one Rajiv Gandhi Fund, that is Rajiv Gandhi Foundation. So you need not remember the fund name. So it is Jawaharlal Nehru, Rajiv Gandhi, Indira Gandhi, three Gandhi families. So you're going to remember the what you call grandfather, mother, and the son. So these three things, this is what you're going to remember. So these three persons fund categorized as without qualifying limit 50%. Apart from this, plus PM Drought Relief Fund. So that is PMDRF. So Prime Minister Drought Relief Fund. So this is one more fund that you need to remember. There are few of the Prime Minister Fund that you have that PM Care Fund. So all this is there. What you have to remember is PM Drought Relief Fund. So only that. So these are the four funds which comes under without qualifying limit. Now we'll come back here. So now I know with qualifying limit, I know that for 100% there is two, that is family planning and Indian Olympic Association. And then I know there is 50%, which has how many? Which has 5. So we said what? Charity, 2 in charity, and then minority community, and then your, so 3, then you have what? Housing accommodation, that is housing accommodation and infra. So that is one thing. And then you have religious, that is restoring. I'll call it historical. I'll call it history. So these 5 funds come under. So I can remember these 7, right? 2 plus 5, that is easy. Now I also remember with qualifying limit 50%. How many it is? It is 4. So it is 3 Gandhi plus DRF, Dot Relief Fund is 1, right? So all this is what I need to remember. So I need to remember these 11. In 11, it is easy to remember these 4, which is Gandhi family and Dot Relief Fund. And 2 is also easy, Indian Olympic Association and your family planning. The 5, you probably try to have some remembrance. So where you have 2 charity, 1 minority community, 1 infrastructure, 1 historical importance. So this is what is actually covered in this 50%. So these 11 I remember. The rest is the balance. Will they give you something which is not in that list itself? No. As I was telling you yesterday about this Jeevan Dara plan and all, about this annuity plans, I was telling you whatever is given in the plan name will probably be the approved plan only. They are not going to give you something that it is not approved. So here also it is same thing. Whatever is given in this 80G list, the 100% list is what you will be tested. So if it is not this 11, if it's something else, it is typically without qualifying limit 100%. Even though if you're going to actually try to remember, you will end up remembering this 11, rest all are called 100%. So that's so probably I would say it is better that you remember. So that is about these limits. Now what did we say? We need to understand how do you actually calculate? Okay, we have this slide. So, but before this slide, I'll probably explain you in this slide itself. So, we already discussed what is adjusted gross total income. It is gross total income minus Chapter 6A deductions other than 80G minus 111A, that is short-term capital gain at a special rate of 15%, and then minus long-term capital gain under Section 112 and 112A, and any income on which there is no tax. I reduce all this. I get adjusted gross total income. On that, I apply 10%. I get a qualifying limit. Now, whatever the donation is made should be calculated, will be categorized independently. And then my first preference should be to give 100% deduction. Once I still have balance qualifying limit, I'll have to give 50%. If it sounds confusing, probably let's not work through. We'll understand the same concept with an exercise problem in the subsequent slide. But for time being, what I'll do is, I'll just explain you. Let's say your total gross total income. We'll take this as adjusted gross total income. Your adjusted gross total income is 6 lakhs. So what becomes your qualifying limit? Your qualifying becomes limit 10% into 6 lakhs. That is 60,000, right? So your qualifying limit becomes 60,000. Now, this is what is your maximum possible donation that you can make in this category of with qualifying limit. Now, let's say I have actually made to family planning. I have made to family planning. How much shall we keep? We shall keep what? 40,000. And for minority community, for promoting minority community, I have paid another 40,000. Okay. Now the provision says first calculate adjusted gross total income. So step one is adjusted gross total income. That is, you calculate the qualifying limit. So how much is the qualifying limit? 60,000. Second, categorize all donation. So 100 percentage is 40,000. 50 percentage is 40,000. This is step two. Step two. So what we are doing is understanding in steps. Okay. So please remember that. And now what I'm going to do is I'm going to restrict. Okay. So I'll use the word calculate. So what I do, my first preference is 100 percentage. So I'm eligible for 60,000. So my first preference is give this 100 percentage. So I give 40,000. So my donation is 40,000. I am eligible for 40,000. So this is donation. This is eligible. That is your deduction. Now, next take 50 percentage. Now I am restricted to 20,000, right? So my donation is actually 40,000. But since I have only 60,000, I'm going to take 20,000 here. Okay. Now comes the fourth step. I'll actually use the word limit here. And now I'll use the word calculate. The fourth step, this is straight away. That is 40,000 into 100 percentage is 40,000. Okay. Second step, 50,000. That is, you are only eligible for 20,000 into 50 percentage. That is 10,000. So total donation allowed is 50,000. That is deduction. So deduction under section 80G will be 50,000. Clear? So this is how this works. So what I've done as 4 steps. First, I'm calculating the qualifying limit. How am I calculating? Adjusted gross total income. On that adjusted gross total income, I'm calculating 10%. That is my gross total income minus ATC, minus Chapter 6A deductions other than ATG, minus short-term capital gain under Section 111A, minus long-term capital gain under Section 112 and 112A, minus income on which there is no tax. After this, I get adjusted gross total income. I apply 10%. So that comes to 60,000. Now I've given donation to 2 parties. So I'm categorizing what is 100%, what is 50%. So 100% is 40,000. 50% is also 40,000. Now I'm going to limit these donations. So first I'm limiting 100%. I am eligible for 60,000. So I'm considering the entire 40,000. I'm considering the entire 40,000 here. So I'm taking the entire 40,000. The next step, I'm left with only 20,000. How is this 20,000 arrived? It is basically 60,000 minus 40,000 is this 20,000. So I'm only eligible for 20,000. So I cannot claim this 40,000. I am eligible for 20,000. Now this 20,000 will be deemed as your donation, will be deemed to be a donation, not the deduction. It will be deemed to be a donation. So it is eligible donation. So now I'm calculating the last step. The fourth step is what I'm calculating. That is 100%. I'm just taking 40,000 because it is 40,000 into 100%. Whereas it is 50%, I'm eligible only for 20,000 donation. So 20,000 into 50%. I'm not taking 20,000. It is 20,000 into 15%. That gives you 10,000. So this is how you compute this eligible limit. So what are the other conditions we need to remember? So there is no deduction under any other provisions if provided in ATG. So if the donation has been provided in ATG, you should not claim anything, which means, let's say you're running a business, you cannot claim donation in expenditure also and then claim also. What will it become? It will become double deduction. It will become double deduction. So it is not eligible. So when you have provided as an expenditure there, you need to disallow that and then claim as ATG expenditure. So it cannot be in kind. So which means it has to be in cash only. Kind is not accepted for ATG. And donation greater than 2000 must be made other than cash. This was introduced from 1st June 20. Prior to that, it was actually 10,000. So for your period, that is your period is actually what? Previous year 21-22. That is 1st April 21 to 31st March 22 is your exam period. For that period, it is only 2000. In the previous year and all, we need to remember this date, 1st June, because whatever was provided till 31st May, the limit is 10,000. From 1st June only, the limit was actually 2000. So it was a critical thing in the previous examination. But for this period of financial year from 1st April 21 to 31st March 22, you do not have that confusion. So you can stay comfortable without confusing with these dates. And then a business connection not required. Probably if you are doing a business, should you donate only what is related to your business, the activity related to your business, or it's okay? So the provision says it is irrelevant. Whatever business you do, you can promote anything. So you can donate for any other cause, need not be related to your business. And in cases like this PM Care Fund or Chief Minister Relief Fund or this Lieutenant General Relief Fund. So what is this LGRF? So don't confuse, it is Lieutenant General. I've already given this list here. So this LGFS, whatever we are talking, is this. So this is what is called as LGRF. So don't confuse beyond a point. So this LGRF, for all these funds, what happens is typically what happens is employer will collect on behalf of the employee. Let's say I'm working in Infosys. Infosys will collect money from me. So what happens is Infosys will collect money from me. So I pay to Infosys. Let's say me, Muthu, will donate to Infosys. Infosys will donate to PM Cares Fund. Okay. Now, for every donation, I must have a valid receipt. I must have a valid receipt. That is a valid certificate for claiming deduction. Now, the certificate, PM Care has to give to Muthu. It's not possible because PM Care has collected money from whom? PM Care has collected money from Infosys. So, giving certificate independently to each of the employee in Infosys and similarly in all other company, it is not possible. So, what does the provision says is, for such funds contributed by the employer, it is okay. So you no need this certificate. So this is what the provision says. So wherever money is collected from the employer, where separate certificate is not possible for every employee, in such case it is okay. The consolidated, whatever payment is made by the employer, it is okay not giving the separate certificate. So they have listed out the funds. So typically for this Prime Minister National Relief Fund, Chief Minister Relief Fund, and Lieutenant Governor's Relief Fund. So for these three funds, a separate certificate is not required. And a new amendment in Finance Act 2020, which is actually applicable from 1st April 2021 is, we were talking about this certificate, right? We were talking about this certificate. Now in this certificate, typically what happens is, in this particular certificate, what happens is, let's take this scenario, okay? There is a fund. So there is a charitable organization. So that will be an approved, only then they are eligible. Now, they will have to furnish annual statement. Now, what will the statement have? It will have list of people who donated. A gave 10,000. B gave 2 lakhs. C gave 75,000. So this list of donees, whoever has donated, will be given this annual statement to whom? To Income Tax Department. Okay. Now, when giving this A, it will tell the PAN of A. PAN of B, PAN of C. Correct? When I file my return, when A files his return claiming 80G, this has to map. Only then A is eligible. Only then A is eligible. So only if the donation maps from the fund institution and the donation. So if your question says a charitable institution has not furnished this annual statement, then the assessee cannot claim the donation. Assessee cannot claim the 80G. Clear in this concept? So that's why I'm explaining the whole process. Basically, it is a charitable organization which is approved. They'll have to furnish this annual statement to income tax department. What will they furnish? They'll furnish list of persons who have provided donation along with their PAN. Now this will get linked to the particular assessee based on the PAN. Like he will claim, I have given to this organization. Let's take this for example. I will specify the PAN of charity PAN saying I have donated 10,000. Now what is charity doing? It will say A PAN, they have donated 10,000. Now only if this maps, A gets the benefit. So this is the concept. So charitable organization furnishes a statement. If that statement matches with the claim provided by the assessee, only then it is eligible. So that's what this provision says. What does this provision say? Donation to charitable institution will be allowed based on the information furnished by such institution or fund. So whatever they are furnishing, so if that matches, only then it will be available. This is applicable from 1st April 2021. So in your question, if the question says that the charitable fund has not furnished information to the income tax department, what should you do? Very smartly, don't provide donation. Don't provide the benefit of donation for that particular donation. So that's all you need to do, nothing else. So remember this alone. If the question says that the charitable fund has not furnished the annual information statement, automatically don't provide the donation. So that's it. So clear? So we'll probably try to understand with this with the problem. So we'll try to understand this with an exercise problem, what our ATG calculation is about. So we'll solve this. With that, we are done with ATG. We'll probably take some of the questions in ATG after this problem. So what does the problem say? The problem says what? Shiva aged 58 years. So Shiva, who's aged 58 years, has gross total income of 7,75,000. Okay, comprising of income from salary and house property. Premium. So why is this word important? What did I tell you? Every word in question is important, either to give you extra information or to confuse you, right? These are the two possible scenarios in your question paper when you're reading each word. Each word will be there to provide extra information or to confuse you. So read the word, see whether it is to give you extra information or confuse you. It says salary and house property. What did we say for adjusted gross total income? We said you need to remove what? Short-term capital gain, long-term capital gain, income on which there is no tax. Both salary and house property does not fall under that category. So there is no adjustment on that terms in that 7,75,000. Clear? So the purpose of using this word salary and house property is to tell you nothing else needs to be adjusted from that. So the only thing that you need to adjust is what? Chapter 6A deductions other than 80G. Okay, the first one is premium paid to insure the life of her major daughter, policy taken. What is the key word here? The word says major. Now your mind tries to go back and understand what did you read in the book, what did you listen in the class. Did the faculty say 80C as major or only restricted to minor? It goes back to that. You go back and remember what did I study in the material. Did I read the word major or not? So please remember the keywords. 80C is for every person in the family, that is the individual, the spouse and the children. Dependency is not important. dependency is important only for 80D. Try to link and understand the provisions. 80 says any child. 80D says only dependent child. So try to link provision so that when you're reading, you'll be able to see the exact understanding of the provision. So life of a major daughter. So major word is confusing. We said two terms, extra information, confusing. This major is confusing. So you ignore this word. So we'll keep it as life of our daughter. Policy taken on 1st April 2017. Is this relevant? Is this relevant? Yes. Why? Because there are various terms, various deduction based on the date on which policy is insured. Before 31st March 2012, we said one. From 1st April 12 to 31st March 2013, there is another thing. From 1st April 2013, there is a new scheme. So that is why this is relevant. So this is relevant because it is after, that is greater than 1st April 13. So this is why this is important. Okay, now is this important? Is this giving you information or confusing? It is giving you information because on this only you will calculate the eligible donation. That is 20,000. See, I'm trying to repeat this thing because you can recollect ATC also. At the same time, you try to know how should you read a question. So that is why I'm trying to stress on this question a little more than generally I do. Medical insurance premium for self and spouse. Self and spouse. So that is another thing. What is medical insurance? 80D. It is allowed for self and spouse. There is a limitation, right? If they are not senior citizen, where does it say? Extra information. So since they are not senior citizen, we need to consider this under 80D. Okay. Donation to public charitable institution under 80G. So public charitable institution, what does it come under? It comes under with qualifying limit. With qualifying limit under 50%. So it is eligible with qualifying limit under 50% because it is charity. Two types of charity. One is directly paying to charity. The other is paying to a government or local authority who will utilize it for charitable purpose other than family promoting family planning. So that comes under with qualifying limit 50%. So that's the thing. Next is LIC pension fund of 60,000. So this is what? 80CCC. Donation to National Children's Fund. Is that part of this 11? Is that part of 11? Just think through the 11 donations that we discussed. Two for 100% with qualifying limit. What was that? Family planning and Indian Olympic Association relating to sports development. So that is two things that we discussed. Then we discussed 5 for with qualifying limit with the thing. So this National Children Fund is not in 7, correct? Now come to this 4. What was that 4? Gandhi family plus drought relief fund. Does this have the word drought relief? Does this have the word Gandhi? No, it does not have. Gandhi family, it does not have. So what do you do? You will have to calculate this without qualifying limit. Without qualifying limit, what is the category? Without qualifying limit, 100%. Very clear. I'm trying to making it simple for you. Donation to Jawaharlal Nehru. What is the word we are reading? Jawaharlal Nehru. So what does it come under? It comes into the family that we are talking about. So automatically it comes as without qualifying limit 50%. Without qualifying limit 50%. Donation to approved institution for promotion of family planning. So approved institution for family planning, what is it? It comes under with qualifying limit 100%. And deposit in PPF, this is also comes under 80C. Clear? So that's all we are doing. Now can we work out the problem? We'll go to the problem. So I'll have as particulars. I'll have an amount column, another amount column, and then a note column, notes. Okay, so these are the columns that are typically important for your exam. So these are the relevant columns that you need to have it for your exams. Okay, now what was the first thing was you need to calculate the gross total income. So you'll have to take the the income computed that is already given. That is your gross total income. So what is that income given? It is 7,75,000. So I take 7,75,000 less chapter 6A deduction. The first one I'm going to talk about is ATC. So you'll have to go in the order. So first is ATC, then what? ATCCC, calculate ATCCE, then come to ATD, and then come to ATG. So come in the order of things, the alphabetical order. So A, B, C, D, right? So come in the alphabetical order. So ATC. So in ATC, what do? You first calculate the LIC. So there are various LIC. So this is one LIC. There are LIC pension fund is 80CCC, medical insurance, family planning. Okay, there is only one LIC, and then you have two in ATC. So there are two things that you have to consider in ATC. So first is for the daughter, right? For the daughter. So what is that you do? You will have to actually multiply 1,80,000 into what is the percentage allowed on actual capital sum assured. That is minimum sum assured. So it is basically two things were given. That is in case if they are covered under 80U or 80DD, if they're 80DDB, if they're covered under this 80U or 80DDB, then whatever we are talking about will be 15% of sum assured. Otherwise, it will be 10%. So what will be allowed is 18,000. Okay. You can write a note, say that the actual donation made is 20,000. The actual premium paid is 20,000. However, it is restricted to 10% of minimum sum assured. That is 1,80,000 into 10%. So if you want, you can write it here also. That is 1,80,000 into 10%. Writing as a note will give some extra information. So what did I say? The valuer will be happy that you have understood the provision and writing. You have understood the provision writing. So you can say the premium paid for daughter after 1st April 2013 is eligible up to 10% of the sum assured. So it is 1,80,000 into 10%. So the premium is restricted to 18,000. And then I have what? PPF. So that is also given in ATC, that is 1 lakh. So you need not write anything for this. Okay, so the ATC total is 1,80,000 total ATC. Okay, then you have ATCCC. So that is pension fund. If it's National Pension Fund, Atal Pension Yojana, it is ATCCD. This is the LIC's pension fund, that is annuity pension fund. It comes under ATCCC. The independent limit of this is 1.5 lakhs. Whatever is paid is how much? 60,000. So this is taken care, this is taken care. Now we are taking care of this. So that is 60,000. I know you're not supposed to mark anything in question, but a small dot or something will help you understand that you have already considered this, so that you know that what you need to do. A small mark, probably in pencil or something, so that you don't do it a big mark, which is basically not allowed. So pension fund is 60,000 is also considered now. And then with that, we complete what? We complete the ATC. So 80 total is 1,78,000. Right? Now you say ATCCE deduction restriction. How much? You restrict it to 1,50,000. Correct? And then you have what? After that, you have ATD, that is medical insurance. What does it say? it says for premium of 12,000 and spouse is 26,000. So self plus spouse, write a note to here, write 26,000 here, write 25,000 here. So this 26,000 is basically restricted to 25,000 because they're not a senior citizen. So they're restricted to 25,000. That must be specified in the note. Or you can write here, or you can write basically restricted to 25,000. But anyway, I prefer separate notes so that you'll have a very clear explanation as to why you are restricting. So that is that. Then what after 80D, what you have? I guess that's all right. So there is nothing else apart from this. Okay. Now we can calculate. So we'll have to allow 80G. So 80G we'll do as a separate note. So separate note, and then you will actually calculate net total income. You calculate net total income. So now we are coming to the main subject of how do you calculate 80G. Okay, so for 80G, that is note 3. You first take the donation, okay? Then you take the category, which category they fall, okay? Which category they fall. And then you take the amount. You take the amount which they are eligible. Then eligible amount. Probably I'll call it as adjusted. I'll call it as qualifying limit, right? So we'll call it as qualifying limit. So you specify what is the qualifying limit. In that qualifying limit, you say eligible deduction, right? So you take eligible deduction. So typically what we are trying to do is, eligible deduction is what you have considered. So this eligible deduction is where you actually calculate. So now we'll come back to this. We'll take each one. We have what? Donation to public charitable institution. We have 2 without qualifying. So we'll write the first without qualifying, that is National Children Fund. I'll write it as NCF. Then you have Nehru, right? So you have Nehru. So this national falls under 100%. Nehru falls under 50%. So that's the thing. And then you have, so Nehru is how much? 25,000 and 25,000, each 25,000. So this is 25,000. This is 25,000. The eligible deduction is 25,000, 12,500. So you can probably write here 25,000 into 50%, right? So that's how you have calculated this. And then you have next to 2, that is charity. You will have to first write family planning because the preference is 100%. So family planning 100%, and then you have what? Charity. Charity is 50%. So what's the amount here for promotion of family planning is 40,000 and charitable institution is 50,000. So this is 40,000. This is 50,000. Okay. So whatever we need to calculate the qualifying limit. So qualifying limit is equal to what? You take the income 7,75,000 minus 1,75,000 is equal to 6 lakhs. So into 10%, that is 60,000. Incidentally, it comes the same number what I was discussing as a formula. So that is okay. 60,000 is what it is there. So now in the 60,000, this 40,000 will be straight away allowed. this 40,000 is straight away allowed. So, and this is restricted to what? 20,000, right? 20,000. So this becomes 10,000. That is 20,000 into 50 percentage. So now your total eligible donation is 37,500, 77,500, 87,500. So this will be your 87,500. So from 6 lakhs, 87,500. So it will be what? 5,12,500, right? So that will be the number which is relevant here. So this is how we have calculated the ATG. So you calculate the donation, you add the category, you have the amount, you restrict it to the qualifying limit, and then calculate the eligible deduction. So that is ATG. I'll probably take some of the questions. So fund donated by other than purpose of promoting family friendly renovation. So I guess, yeah. So typically, what I would like to tell you is whatever you've asked, we need to understand this category. The 100% and 50% category is what we need to understand. As I told you, we need not remember each one in that 100%. So remember these 5 plus 2 plus 4. So these things alone remember. The rest is technically will fall under the thing. Will fall under as 100% with qualifying limit. Yeah. Right. So I guess that's what it is. So I hope you have understood. So I'll proceed on with the next section of 80GG. So what is 80GG? So 80GG is typically is for persons who do not have house rent allowances. So the persons who are not receiving house rent allowances will be classified under 80GG. So typically, the one of the primary condition is yes, they should not receive HRA. So this is the first condition. The second condition, it must be for his own residence. The third condition is he should not be probably assessee or spouse or child should not own any accommodation. So they should not have an accommodation and still claiming this 80GG. So not just he, it could be he, his spouse, and the child. So any of them in the family should not own any property accommodation at the place where he ordinarily resides, works, or carries business. So possibly, if a person is working in Mumbai, the assessee, spouse, or children should not own any accommodation. In case of HUF, any member of HUF should not own any accommodation. So that is what it is about. So the assessee, spouse, children, or the HUF that he is part of should not own any accommodation in the place where he ordinarily resides, works, or carries on business. So that's what you are actually calling it. So this provision is only applicable for people who don't claim HRA benefits. So typically it is for non-employees who's not working. And if assessee owns property, in case if he's owning in any other place other than the place where he ordinarily resides, works, or carries on his business, if he owns that other property, that property should not be self-occupied or deemed to be let out. So typically, what income tax department is trying to tell you is, it says, see, I will give you this rental benefit, but you don't misuse the benefit. When can someone generally misuse? I already have a property, I'm again renting it. So that is one way of misusing. Like I'm paying my rental to my wife, I'm paying rent to my child. So all this is what probably is misusing. So this is not allowed. So you cannot have someone in your family owning a property. So that is not allowed. So in that case, and similarly, what they say is, in case if you have any other property in another city, don't tell that is also self-occupied. So if you're claiming rental income in that, if you're treating that as house property income and disclosing it, then okay. Otherwise, it is not right. So typically what they're saying is, don't have a property in the location you are, or don't have a property outside your location which is self-occupied, or deemed to be let out. So deemed to be let out is also kind of self-occupied, right? So that is also not allowed. So that is the condition. Now, what is the deductions? Exactly similar to your HRA. So we will remember the HRA provisions first. What are HRA provisions? Actual rent paid minus, instead of 10% of total income, it is 10% of salary. Correct? So it is 10% of salary. So that is HRA. Instead of 25%, it used to be 40% or 50%, depending upon the location. Instead of total income, it is salary. And instead of 5,000 per month, it is actual HRA, right? So this is what HRA. So similar lines, exactly in similar lines, similar to your HRA, you have another provision for calculating rental benefit. What is that? Actual rent paid minus 10%. You are not only earning salary, so it is total income before this deduction. Similarly, instead of 40-50% of salary, it is 25% of your total income. And finally, instead of actual HRA, it is 5,000 per month. So least of the following. So this is how you calculate 80GG. So we'll see an exercise in this also. Mr. Ganesh, a businessman is typically whose total income before allowing deduction is 4,60,000. He paid house rent of 12,000 per month in respect of residential accommodation occupied by him at Mumbai. So it is occupied at Mumbai. Compute the deduction eligible to him. So that's what we need to calculate. So what is that? We need to calculate 4,60,000, right? So we'll have to calculate first thing. Actual rent paid is 1,44,000. How did I get this 1,44,000? Very simple math. 12,000 into 12. So 12 square is 144. So 12,000 into 12 is 1,44,000. Actual rent paid minus 10% of your total income before this deduction. So it is 46,000. That is 4,60,000 into 10%. Correct? 4,60,000 into 10%. So this will be what? 98,000. So 98,000. What is the second thing? Second thing is actually 25% of total income, right? So 25% is 1,15,000. That is 4,60,000 into 25%. 50% is 2,30,000. Half of it is 1,15,000. Third one is 60,000. That is 5,000 into 12. So now I need not teach you to tell you how to identify whichever is less. So which is less? Right? So the 60,000 is what eligible. So is total income. Will be 4,60,000 minus 60,000. It will be 4 lakhs. Right? So that will be the income. So any doubt in this? Okay. So we'll move on to the next section. We are going to cover 3 sections next before going on a short break. So the 3 sections, it's 80GGA, 80GGB, GGC. Okay. What did we say when we spoke about G is basically donation. So G is donation. GG is basically an additional benefit given to you by the government for rental purposes. That is GG. Now this GGA, GGB and GGC is also donation only, but to specific purposes, not like your G, general donations. It's not like that. GGA is restricted to donation for scientific research and rural development. In business or profession, there are few sections which talks about the scientific research and rural development. So scientific research is discussed in 35C and rural development is discussed in 35CCA. So whereby 35 provides, if you are providing money to certain institutions or universities, whatever donation you have made is eligible for deduction. Similarly, rural development say, if you are investing money, if you are spending money in eligible projects, you are eligible for a deduction. So this is 35 CCA. I'm not going to explain you about this section, but the concept, whatever you would have probably already discussed in section 35 and 35 CCA is what we are going to see here. So what does 35 says? 35 says any money paid to a research association with an object. I've used the word such here. The such refers to scientific research because the purpose of this itself is scientific research. So research association with an object of scientific research. So that is the first thing. Or to an university, college, or any other institution used for scientific research purposes. So this is also replaced. So such refers to scientific research. Now, for this purpose, they can give donation. This is scientific research. The section 35 also talks about statistical research. Same concept here, just that what changes is not just scientific research, the object is also social science or statistical research. So these both are what? Same. These both are same. And then you have rural development under section 35 CCA. Rural development under section 35 CCA. So that is what is discussed here in this section 35 CCA. Used for such purpose or whatever. Now, any eligible project or scheme. So that is rural development. So rural development is basically you are giving to what does the such refer here? Such refers to rural development. So any association with an object to be used for rural institution, it could also be for training of implementation of such programs. I don't know if you have heard about this company called Zogo. They basically have offices in very downtown villages where they train such people, and make them their employees. So it is basically training an employee in a very small village, whereby you are actually developing the rural itself, the village itself, right? So that if amount is being spent for such purposes, whatever is being deposited into that for such donations for such reasons is eligible. Similarly, any eligible project or scheme. So relating to 35 CCA itself, if there is any public sector company where it is approved by the national committee to conduct a project of national importance. So if that is there, then whatever is we are talking about is also eligible. That is fund set up by central government. Rural Development Fund development under section 35 CCA with the intention to eradicate poverty. National Urban Eradication Poverty Fund, Poverty Eradication Fund. So if contribution is made into that. So the point is, if the donation is made in these statistical research, social science or statistical research, rural development, eligible project or scheme, fund set up by central government, that is National Urban Poverty Eradication Fund. If it is being to one of these funds, then you can claim exemption. What are the conditions? That person must not have PGBP. Why? Very simple. If you have PGBP, you will claim this deduction under section 35 or 35 CCA. So these are provisions probably you need not remember at all. It automatically comes. Just think about the logic of how this provision comes. Why do they say that you should not have profit and gains from business or provision? Because that would have already been claimed under section 35 or 35 CCA. Then why do they claim under 80 GCA? If they claim, it becomes double deduction. We have been stressing this concept, double deduction. So that is the reason it is not applicable for PGBP persons, right? And then you have donations greater than 2,000 must be other than cash. Here also I said it was actually 10,000 till 31st May 2020. However, this date is no more relevant because whatever is going to be questioned as a donation in your question paper will only be between period 1st April 21 to 31st March 2022. So you need not worry about it. So donation greater than 20,000 must be made other than cash. 10,000 up to 30,000. Not allowed under any other provision. As we said, if you are claiming donation here, you can't claim it anywhere else. So you'll have to disallow in the provision and claim it as donation deduction under section 80 GGA. On the basis of same whatever we saw in 80G. So if you see these conditions are all exactly similar to 80G, so you need not worry about it. The only additional condition, whatever is there is additional from 80G. So this alone was not there in 80G because persons having business or profession also can claim 80G. But here, if you're having business or profession, this provision is not applicable. What is applicable is your What is applicable is your 80 business 35 and 35 CCA. So these are the provisions of 80 GGA. Now we'll move on to the next provision. So what is the next provision? It is 80 GGB and GGC. This is contribution to political parties. So GGB says contribution given by companies. GGC says contribution provided by any person, but excluding local authority or artificial judicial person, wholly or partly funded by government. So it is basically you exclude government funded authority and artificial judicial person. What you consider is only contribution given by any person. So that is 80 GGC. So company is GGB, other than company is GGC. How do you remember B for company? Generally, C must be company, but income tax has changed it. So remember this. Generally, C is for company, but income tax has not followed this concept. So GGB becomes company, GGC becomes any other person. So that's what is probably you can understand. I'm just telling you a way. Probably if it is easy, you can adopt, or you can follow any other way you actually have it. So there is no rules to how to remember and all. Whatever is convenient to us, whatever things our mind will remember, follow the methodology. That's all. So we also spoke about some methodology in the last class about how remembering the section numbers also. Okay, coming back to this, 80 GGB and 80 GGC are two provisions. GGB is for companies, GGC is for any other person other than the company. Now, what is this contribution they are talking about? They are talking about subscription or payment likely to affect support of political party. So, let's say a particular company is providing contribution to BJP, Congress. So, it could be any party. They are giving to a political party, funded to a political party. It could be expenditure also could be incurred for behalf of that particular party. I am printing on advertisement in any publication. So what do you mean by advertisement and publication? You mean as souvenir, brochure, pamphlet, etc. Anything of this kind will be called as an advertisement expenditure. So it could be by or on behalf of the political party for its advantage. So it is basically for the advantage of political party. I publish something in the media or something. Whatever advertisement expenditure is incurred is allowed. Either I myself could spend or give it to a political party and say you use this for publication. So this advertisement expenditure, publication expenditure is also eligible. But this provision, this advertisement publication, if we are actually running a business, it is disallowed. It is disallowed under section 37. So 37 2AA says that any expenditure to political party for advertisement or this public souvenir is not an allowed expenditure in business. Of course, it will be disallowed there, but you can always claim a deduction under section 80 GGB as a company. If it's not a company, it is 80 GGC. So that's what it is. We'll just try to understand with a small exercise. ARC Limited, an Indian company, contributed to 2 lakhs to electoral trust. Electoral trust is also for the purpose of political party only. So that is also accepted. Incurred expenditure of 20,000 for advertisement in a brochure of a political party. So what happens is the company eligible for deduction in respect of contribution expenditure was made by check. If so, what is the quantum of deductions? So basically both the expenditure allowed. So 2 lakh and 25,000. Only thing is this 25,000 should be disallowed in the provision under section 37 2AA. So that's what. So the entire 2,25,000 will be allowed as a deductions. So any doubt about this? Okay. So since probably we have some 5 minutes or something, before we go on a break, I'll just give a brief idea of what the next provision that we are going to see about it. So there is this concept of heading C in chapter 6A. Okay. So generally chapters are what Income Tax Act has. Under chapter there will be headings. So in heading C, you have various deductions called as profit linked deductions. So which means your deduction is based on the income you have earned. Your deduction is based on the income you have had. Apart from that, you have few other provisions also. So this is covered in final. This is covered in final. So you need not worry about this particular section. So you have various provisions of, let's say, AT, IA, IB, all those things. So we are going to ignore those. It is purely for your final. Apart from that, you have various provisions relating to new employees. That is called as ATJJAA. Then you have royalty income and patent income. So this is ATQQB and RRB. So these are the two provisions which will be discussed in inter. So these three provisions only will be covered in your intermediate syllabus. The rest all is what probably you'll be learning a little later after you complete this course. So this is what we are going to understand this particular provision. We are going to understand the first one as ATJJA, that is relating to additional employee cost. So if you actually see, as we said, it is for new employees. An assessee to whom section applicable. So it is only applicable to an assessee to whom 44AB is applicable. What is 44AB? 44AB is tax audit. Right? 44AB is tax audit cases. So it is only applicable for tax audit cases. They shall claim 30% of additional employee cost. So the word used is 30% additional employee cost. So what does your mind says? What is additional employee cost? We need to understand this term before actually understanding the provision. It is eligible for 3 assessment years. So you claim 30% this year, 30% in the subsequent year, and 30% in the next year. So 30% is divided for 3 years, and in each year you claim it for 30%, which means you claim 90% over 3-year period. Apart from claiming the entire, whatever salary you are paid will be an expense, right? You would have already claimed. Apart from that, you are additionally provided 30%, which these things are called kind of weighted deduction. When I say weighted deduction, I have already claimed 100 in my expenditure. I am saying you claim another 30 now. So which means above 100 is what I am claiming. So this is why it is called as, I'm just telling you this term for remember. Weighted deduction is something like you claim 130% of your expenditure. Here I am saying you claim 100 in expense, 30 in deduction. 30 in deduction. So this is why I'm calling it as weighted deduction. So this is what we are doing. In some cases, deduction shall not be allowed. Deduction shall not be allowed. So basically, the business is formed by splitting up of reconstruction of an existing business. So just to use this, misuse this provision, what if I'm just splitting my business into 2 divisions? Let's say I'm manufacturing biscuits, I'm manufacturing chocolates. I'm splitting this biscuit as one company, chocolate as one company. Whatever employee I'm moving from this biscuit company to this exclusively to this chocolate company is not new employees. So that's why they say it is not splitting up or reconstruction of an existing business. So that's the first condition. Second condition is also similar thing. I'm transferring to someone. Now I say I have business and chocolate business. I'm transferring my business to another entity, a new entity. That entity, since the employees are new to that organization, doesn't mean they are new employees. It is an existing employee just transferred. So transferred organization is also not covered under this. Finally, to claim this deduction under ATJJAA, not just ATJJAA, any deduction under section under this heading C of chapter 6A, any deduction, you will have to file the return of income. You will have to file a additional statement before the relevant due date. So for this case, you will have to file it as Form 10DA before 1 month prior to the due date specified under section 139(1). I'll not confuse this due date as of now because I guess we are yet to cover this chapter of return filing and other things. So as of now, we'll understand it is 1 month prior to the due date of return of filing, which is nothing but your due date for tax audits. So typically, we'll keep the date as 30th September. So just remember it as 30th September. There is a detailed chapter to understand these dates and other things. So as of now, we'll keep it as 30th September. So the due date for 44AB, if you have already covered in your business or profession, probably you would be knowing this date. Otherwise, let's remember that 1 month prior to the due date of return filing, this form has to be filed. Form 10DA has to be filed 1 month prior to the due date of filing return of income. So this is an amendment in Finance Act 2020. That is the due date amendment. So that's what it is about. So we'll take a small break before we understand the concepts of this 80JJAA. So we'll take a small break. Thank you. So welcome back. So whatever we have been discussing is about this heading C deductions. We said only three are eligible for intermediate. The first one we said is 80 JJAA, which is relating to new employees. So we saw the conditions. It is applicable for persons who are covered under this tax audit. They can claim 30% of additional employee cost over 3 assessment years. And we said persons who are claiming such business should not be formed by splitting up of reconstruction, transfer, and to claim this deduction, they must file this form 10DA before the due date specified in the section 44AB. That is 1 month prior to the due date of return of filing. So now one of the questions that we checked here is, what is this additional employee cost, right? So we wanted to understand that. So this additional employee cost is what we are going to discuss here. And when we are talking about this additional employee cost, we will also understand few other terms. So typically additional employee cost, the word uses total emoluments paid or payable to additional employees. So first we said additional employee cost. Now we are having two more keywords, emoluments, additional employee. So we must understand what is an emolument. We must understand what is an employee, additional employee. So we'll first understand what is an emolument before coming to this. So emolument is basically, so we'll understand this first. So emolument is basically paid or payable to an employee. What can it be? Salary, wages, or whatever. So you're paying it, but does not include any contribution to pension fund, provident fund, or any other fund. So that is not included. Similarly, any lump sum payment made to an employee at the time of termination of the service or superannuation or voluntary enrollment. So what are not covered? Anything paid by the employer to provident fund, pension fund, or any other fund. Similarly, any lump sum paid during termination of that particular employee. It includes the superannuation, any voluntary retirement or something. So these things are not considered. Any other payment made to the employee is called emolument, okay? Paid or payable to additional employees. So now we need to know who is an additional employee. So we'll understand that right now. Who is an additional employee? Employed during the previous year. Employed during the previous year is the additional employee. So that is, they must have been recruited. In your examination, let's take it is between 1st April 21 and 31st March 2022. In this period, an employee should have been appointed. But does not include if the emolument is more than 25,000. So if the emolument is more than 25,000, we need to exclude such employee. Entire contribution is paid by the government under the employees pension scheme. So the government is contributing the entire pension fund, provident fund from their own fund. Then such employee should also be not included. And lastly, the most important thing is, if a person is employed less than 240 days in that particular year. So in the previous year, the person is less than 240 days, which means he is appointed, he is quit. He is appointed, he is quit within the same year. So he has actually been working only for less than 8 months. Why is this relevant? There is this concept called temporary workers, right? I hope you would have heard. So there is this concept called temporary workers. So this temporary workers is basically part-time, or let's say contract workers. So these are all called as the temporary workers. So this temporary workers is seasonal business. Let's take firecrackers is one of the examples, right? So this is the manufacturing of this firecrackers, the production of this firecrackers will be seasonal. So only during that period you will recruit employees. You will ask them to leave after it is done. So these are called temporary workers. So to not provide benefit for such contract employees, recruiting contract employees or temporary workers, the income tax department through this section says that additional employees refers to employee who have been working, who are recruited and works more than 240 days, typically more than 8 months in that particular organization. But this 240 days is different for certain businesses like apparel, footwear, leather business. For these three business, it is not 240, it is 150 days. So this 150 days is considered, that is 5 months. So instead of 8 months, what is covered is 5 months. So that 5 months is sufficient to be called them as additional employee. And when we're talking about this new employees, we said 240 days, right? What if we were recruit a person on 1st December 21? So till 31/3/22, the total number of days will be what? Only 4 months, right? So 3 plus 4, let's assume 120 days. So it is less than 240. It is less than 240, correct? So can we say this employee is not eligible? No, this employee is actually eligible because he has worked less than 240 days. For what reason? He is recruited itself is less than 240. So he cannot work for more than, how can he work for 240 days if he is employed on 1st December 21? It's not possible, right? So for these employees, so this set of employee, we need to consider in the next previous year. That is, we'll consider it in 2022-23. So for this period, that is previous year 21-22, we will consider in the previous year 21-22. So this period will be considered in previous year 2022. Whatever cost belongs to this year will be considered in the next year. So they are giving that benefit. So the first year starts from this particular period. So that will be added. So these employees will be called as additional employee in previous year 2022-23. Everything related to emoluments, everything is for this year only, but they'll be called as an additional employee in the next year. We'll solve a problem, probably you'll understand it little better when you're doing it. So for time being, let's understand a particular employee should work for more than 240 days in a year to be called as an additional employee. But if he himself is recruited in a period where it's not possible to serve 240 days in a year, then the next year, if he has served 240 days in the next year, that shall be considered as the year. That year will be considered as the next year. So that is what the provision is. So what does the provision says? If you actually see, it says treat new joinees less than 240 days. So their recruited itself is less than 240 days. Treat them as additional employee in the subsequent year. So this is the provision. Same thing in case of apparel, footwear and leather business. What is the number we need to take? Instead of 240, what should we take? We should take 150. So that's the point, right? Employees not participating in recognized provident fund. So the one who are only contributing into this employees recognized provident fund, only such employees will be considered. The rest of the employees will actually not be considered as an additional employee cost. So these are the provisions basically. So what is the reason now? So we have now understood who are all called as an additional employee. Basically, the employee must be recruited in the previous year. Such employee should have worked for more than 240 days. In case if he himself is recruited for less than 240 days, then it is fine. Consider them in the subsequent year. For certain business, leather, apparel and footwear, it is not 240, it is 150 days. And the third point is contribution to this pension fund. If the government is contributing, don't include such employees. Similarly, if an employee is not contributing to recognized provident fund, ignore them also. So apart from these four situations, any new employee will be called as an additional employee. Now we will understand what is an additional employee cost, because what is allowed is 30% of this category only, right? So now we'll understand this additional employee cost. What is additional employee cost? We said emoluments paid to the additional employee. So emoluments paid to the additional employee is called additional employee cost. But they are saying additional employee cost shall be treated as nil. Though there are new additional employee, though you have new joinees, the provision says treat them as nil in certain situation. What is that? If there is no increase in number of employees between the years, we'll see this. Financial year financial year 2021. Financial year 21-22. Okay. So opening, I had 100 employees. Okay, I had 100 employees. New joinees, I'm taking 25. Attrition, that is exit. I'll call it as exit because it's called as attrition. So what is this thing? I'll take as 10 employees. Now this is 115, correct? So technically the 25 employees are new employees. This is fine. Let's take in the next year, openings 115. I have appointed 30, 30 have exited. In this case, both are equal, right? Same. So there is no change. So there is no change. No change in the count. So this is what it says. If number of employees from the total number of employees as on the date of preceding year, that is 31st March 2021. If the number of employees on 31st March 2021 and 31st March 2022 is same, then it shall be treated as nil. Though there are new employees appointed, when will this happen? That's what we discussed. It will only happen when there is equal addition, equal attrition. So only then that will happen. So and then it should be paid by account payee check. So typically prescribed electronic clearing modes. What are they? NEFT, RTGS, UPI, BIM, all these prescribed electronic modes. If they are paid through that, then it will be called as an. It will not be called. If it has to be paid. If not paid through this electronic prescribed mode, then automatically they will not be considered as an additional employee cost. So only these employees basically insert. Additional employee cost will be total emoluments paid to additional employees during the previous year, but it shall be nil if there is no change in the total number of employees from previous year and this year. And additionally, if the payments are made by modes other than by account payee check or prescribed electronic modes. So that is what you called as an additional employee cost. Clear? So this is what it is. Now we'll understand this with a problem. So what does the problem say? It says A has commenced business of manufacture on 1st April 2020. He employed 350 new employees during previous year 2021. Okay, previous year 2021. Just remember the date alone as 21-22 because the relevant year for you will be 21-22, right? So just remember each of this as if it is 21 year. So just take it that manner. So there are 75 new employees. Date of employees employment is 1st April 2020. It's a regular employee and the emolument is 24,000 per month. For 125, it is 1st May 2020. Regular employee, that is 26,000. And then for 50 employees, it is 1st August 2020. They are casual employees. Casual employees will typically, like contract workers, they will not be part of this recognized provident fund at all. So their emolument is 24,500. Finally, you have 100 employees whose regular employees, where the total monthly emoluments is 24,000 per month. Now the first condition is the emoluments must be less than 25,000. So now these three people are eligible, right? And the second condition is they must be working for more than 240 days. So how many days are they working? The first category is working for 365 days. The 1st August 2020 category is casual employee. Are they allowed or not allowed? They are also not allowed. So they get eliminated under this category. 1st September 2020, they are regular employees and whether they have worked for more than 240 days. So if you're talking about September, it is September, October, November, December, January, February, March. So it's worked for 7 months. So when you say 7 months, what is the thing? When you say 7 months, what is the exact thing that we are talking about? So we want to say that regular employees recognize from, while casual employees do not. So that's why we are ignoring the casual employees. So now they wanted to understand the deduction for assessment year 21-22. If the profits of gains derived by 75 lakhs and his total turnover is 5.16 crores. So why is this turnover relevant here? Why is this turnover relevant here? the turnover is relevant here because of what? We need to understand whether he falls into this category of 44AB. Only then he is eligible. So anything more than 1 crore is applicable, right? 1 crore falls into this 44AB. So 5.16 crores is eligible for this 44AB. Now, the 75, 125, 50 and 100 is the new employees. The first category regular is covered. The second category regular is not covered because it is more than 25,000. The third category is not covered because it is casual employee. The fourth category we are talking about from 1st September 2020 to 31/3/2021. So the total number of days will be what? 30 in September, 31 in October, November, December, January, February and March. So 61, 91, 122, 153, 181, 212 if I'm right. So this is less than 240 days. But why have they worked less than 240 days? Because their employment itself is only from 1st September 2020. So they are unable to work more than 240 days. Not that they have resigned or something. They are unable to work less than 240 days. So that's the reason why we are saying that this must be ignored. So right. So now this will be considered for next year when you're actually computing for previous year 21-22. It will automatically be included for 21-22. So that's what is. So we'll try to compute the numbers. So what will be the number? It is 24,000 per month from 1st April 2020. Correct. So for the first set of category of employee, it was joined on 1st April 2020. It will be 75 employee into 24,000 into 12, right? So 24,000 into 12. So this into 30%. We'll calculate 30% separately. So this will be how much? 75,000 into 24,000. 24,000 into 12 into 75. So total is 2.16 crore. Is there anyone else that is included? This 26,000 is not included. Then this 24,000 is also not included. So you currently have only one category of this employee for this category. So this into 30%. So what will be that into? That will be 64,80,000. So this is what will be eligible for your 80JJAA for this financial year 2021. That is previous year 2021, assessment year 21-22. For AY 22-23, you will include the salary. They include salary for this 100 employees. 100 employees. What was the thing there? 100 employees, 24,000. We'll have to calculate only for this year. So that is their work from September, right? So September to March. So September to March is, again, it is 24,000, right? 24,000 into 7. So which is basically 1,24,000 into 7 into 24,000 into 7 into 100 employees. This is 1 crore 68 lakhs. So even for assessment year 22-23, even for assessment year 22-23, we will have to calculate only for the period September 20 to March 21, because it is for that period only. You are just treating them as an additional employee for this year. Remember this. So 1,68,000 into 30%, correct? So what will be the 1,68,000 into 30%? It will be 50,40,000. That's this will be treated as an additional employee for this year. So they will be considered as an additional employee for this year. So moving on. What would be your answer if Mr. A has commenced a business of manufacture of footwear? What it becomes 150 days? Then this will also be eligible, right? So then in that case, both this will be eligible for previous year 2021, assessment year 21-22. That is how much? 115 20, right? 1 crore 15 lakh 20,000, right? So that is how you actually compute for the next year. So that's the provision. So this is how we compute 80JJAA. So this 80JJAA is what we have discussed it right now. As I said, emoluments of additional employee is what will be considered. So in that case, we said both this in footwear industry, we said 150 days. For rest of the thing, we said it is 240 days. So that's what it is about. So we'll move on to the next section of 80 QQB and 80 RRB. So basically QQB is for authors, that is who's writing books and other things, authors. Author who's an individual resident. So the conditions are he must be an individual resident and he must be receiving income. He must be receiving income as an author. So he is eligible for a deduction up to 3 lakhs. So that is what is eligible. Whereas 80 RRB is for royalty, is for patents. So 80 RRB is for patents. So if patents is for royalty, it's kind of royalty, right? So you register a patent, you get money for what you have registered. That is called royalty. So royalty comes under 80 RRB, R for royalty. So here also it must be an individual resident. Patent must be registered after 1st April 2003. He can either be the first inventor or co-owner. That is, he alone is the owner, or there are like 3 people involved. All 3 are actually first inventors. It is still okay. So they can also be called as including co-owner. So that's what is there about. Here also the deduction is only up to 3 lakhs. Now we need to see how is this computed. This we said for QQB also it is 3 lakhs. For author being a resident. For RRB also it is a patent holder including this co-owner. For them also it is 3 lakhs. Now what are the other things that we need to consider? First we need to understand what will be considered as an income. As far as an author goes, the income could be a lump sum consideration. That is, what do you mean by lump sum? See, I am going to use your book. For using your book and publishing your book, I'll give you 1 crore now itself. This is lump sum. So this lump sum is also an income for the assignment or grant of any interest in the copyright of any book, being work or literary book. So, but this provision is not applicable for textbooks. Textbook is something, let's say I am a chartered accountant, I'm publishing a book for students, then it becomes a textbook. So that's what you call it as textbook. And any royalty or copyright fees, which is not lump sum, which is receivable, which is for everything else, then in that case also it is there. So basically, I am getting a lump sum consideration or as a fees, both are included. So not just lump sum, both lump sum and fees is included. So what is the eligible income? This is the overall income. What is the eligible income? See, in case you need to check whether the amount is lump sum consideration. If it is not lump sum consideration, up to 15%, whatever income that you are receiving, up to 15% value of such books sold during the year. So whatever are sold during the year, the maximum eligible income that you can claim as deduction is 15%. So if someone is giving you more than 15%, then it is not eligible. So in case if it is a lump sum consideration, whatever income you have received, that money, if you have received 1 crore, it is 1 crore. If it is not lump sum, the maximum amount is 15%, 1/5 of the value of such books sold during the previous year. So that's the provision. Other than that, the other condition is this income is typically any income from any source outside India. So if you have actually received this income outside India, you should make sure, the author should make sure that he's bringing back the money into India within a period of 6 months. from the end of the previous year in which such income is earned. So how do you treat this? If you have actually received it on, let's say you have actually received it on 10th February 2022, the year end is 31st March 2022. 6 months from this will be what? Will be 30th September 23. So within 30th September 2023, the money should be brought back to India. Otherwise, you are not eligible for deduction. So this is the condition. So eligible income is basically whatever lump sum or royalty that you are receiving, copyright fees or royalty fees, whatever you are receiving is called income. Eligible income is basically, if it's lump sum consideration, the whole of such money. If it is not lump sum, up to 15%, up to 15% of the value of books sold during the previous year. So that's what the provision is. So this is what will be the income if repatriated into India within 6 months from the end of the financial year in which the income is actually earned. So that's what it is about. So to claim this deduction, a Form 10 CCD should be filed. Form 10 CCD should be filed with the Income Tax Department within the due date of return filing. Royalty in respect of patent registered on or after the first day April 2000. So with respect to royalty, what is income? Which is basically a patent is registered after 1st or April 2003. If he is transferring all the rights, whatever I've created, I'm transferring it whole. That income is called as a royalty income. So I could either sell or get some money for transferring the right. Transfer of right, providing of information, use of patent. So if this is happening, then what happens is that money on royalty or patent registered after 1st April 2003, that money will be treated as my income. That income should also be brought within period of 6 months from the end of the previous year in which the same rule applies. For this, it is 10 CCE. So that's what the provision is about this royalty income and author. So this is about royalty. One is for author, another is for patent holder. For patent holder, it is RRB. For author, it is QQB. So that's the difference. Right? So now the next thing is, when we had started with this chapter 6A, we said we will be understanding in certain categories, right? So we said we'll first understand payment basis. So there we discussed about 80C to 80GGC. These are all payment basis. Then we said heading C, that is income based. So that is 80JJAA, 80QQB and 80RRB. Then we said other income, right? That is 80TTA and 80TTB. Then miscellaneous, that is others, that is 80U. So now we have covered these two. We have already covered these two. Now we will see the rest of the thing. Before seeing the rest of the thing, I'll see if there are any questions that I need to answer. There's question on this 80GG. 80GG, as I told you, it is similar to HRA only. The rent paid, the actual rent paid minus 10% of total income, 25% of total income, 5,000 per month. Understand this with HRA so that you will remember both. So understand in that manner. Make sure you're doing that. So that is what 80GG provision is about. And yes, in our problem, 60,000 was eligible for deduction. So the Dubey is asking about whether 84,000 is taxable. It is not like your HRA where you deducted there. This is called deduction, right? This is called deduction. So what you call by deduction is you claim deduction as 60,000. It is not about 84,000 is 84,000 is deductible. It is actually 60,000. You don't include. So the least of the thing. We'll go back to the 80GG which we wrote here. This problem. This 60,000 is your deduction. This 60,000 is your deduction under section 80GG. The reason I'm doing here to identify the net total income. So it is not 1,44,000 minus 60,000. 60,000 is deduction. That's all. That's a difference from HRA. HRA, you are trying to understand how much is exempt. Here you are providing deduction. So 60,000 is a deduction. Ashish, is there any limit on 80 GGA? No, there is no limit on 80 GGA. Whatever you're donating is eligible. But of course, your total donation cannot exceed your gross total income, as we discussed earlier in 80A. Namrata, what if the donations are made by cash, if the entire amount, that is, if whether the 2,000 alone is disallowed or the entire amount, We said more than 2,000 should be paid in banking mode, which means if not, the entire amount is not eligible for donation at all. So it is not about a disallowance and all. If you are paying donation by 10,000 in cash, it is not eligible for ATG. So there is no concept of disallowance. Remember the word disallowance. Disallowance is when you are provided and then not allowing. This is about deduction. You are only freshly providing. So if it is actually not there, one thing. Only in your business income, when you are talking about your business expenditure, like 40A and all, cash expenditure more than 10,000 is disallowed. There only you bring the concept of disallowance. Otherwise, it's not about disallowance. Whether additional deduction under 80cc D1B, so that is 80cc-D, whatever we saw in our problem was 80cc-C. Whatever we saw in our problem was only 80cc. This only we saw. So the breakup of 1B additional deduction is only for 80cc-D. That is your approved pension scheme by the government. ITL Pension Yojana. This Namrata, the question on this birth date, the 1st April, it is across the Income Tax Act. So wherever you are calculating the 60 years, you'll have to calculate it based on the provision that you have already studied in your senior citizen rule. So if someone is born on 1st April, we'll have to include them as 60 in the previous year itself. So that, yes, that will be applicable to deduction also, not just deduction. Wherever you are calculating senior citizen, the clarification provided, the circular provided for 1st April is applicable for the entire Income Tax Act. The number of 240 and 150, Jamil, we are talking about more than 150 days. More than 150 days. So it must be 150 is not included. It is more than 150 days. Parsha, the question on 30% for 3 years, it is not on increment, it is on the 1st year. Whatever you have provided for 1st year will be available for the next 3 years. Good question. So the 1st year, whatever 30% we have actually calculated will be applicable for the next 2 years also. We should not recalculate. Whether we should take for additional employee or difference between additional employee and attrition, we should do it for additional employee. The reason why I was explaining about attrition, is to just tell you, this is just to tell you that the provision, this is only to tell you that the provision is not applicable if the difference is nil. Addition minus attrition is nil, but the calculation is only for this. This is only additional, not the difference. So that's what it is about. This additional employee cost will be considered as an expense also, will be considered as a deduction also. So that is one. Why 1st May employees are not included? I'll go back to that question. 1st May is not included because the emolument is 26,000. That is more than 25,000. If your emolument is more than 25,000, then you should not include. So that's the reason why we did not include. So then should be considered 1 month also, 8 months which was left. No, we should only calculate for 7 months because for that year they have only worked for 7 months. So we should not include 8 months. So the persons who have worked on this category have only worked for 7 months. So for calculation for additional employee cost, you will only calculate 7 months, but just that you will do it in the next year. So in case because they were not able to work for 240 days because that they were employed for less than 240 days. Yeah, Rogini, I'll just explain this assessment year 22-23 again so that we all have a better clarity. Where is it working? Yeah. See, for the 1st September 2020 employee, they're actually working less than 240 days because they were recruited for less than 240 days, right? So this reason, that is recruitment itself is less than 240 days. In that case, what the provision says is included in the next subsequent year. Don't change any calculation. Whatever you'll have to calculate, but treat the deduction in the next year because we need to say whether they were continuing in the next year also. So if they are continuing in the next year, treat them as an additional employee for next year in that year and take it as under whatever period they served in that year only. So that's how we calculated for the assessment year 22-23. Distinguish between 80 QQB and 80 RRB. You write a book, it is 80 QQB. You invent something, it is 80 RRB. Clear? 80 QQB is when you write something. You get money for writing something, QQB. You invent something, 80 RRB. I'll probably write it for better understanding. You write, it is 80 QQB. You invent, it is 80 RRB. So both of this, you get royalty. For QQB, it is because of writing something. RRB is because of inventing something, new invention. So this is what is RRB. So that is why you call it as 80 QQB and 80 RRB. So any other question? Another good question. Whether you can opt between HRA and 80GG, this is not an option. If you have eligibility, and that is if you are claiming HRA, you are not eligible to claim 80GG. That's all. You are eligible to claim 80GG only if you do not have house rent allowance at all. Your employee does not pay you house rent allowance. So in case if you need this 80GG, you will have to tell your employer, don't give me HRA. Only then you are eligible for 80GG. So it's not an option. If you have claimed HRA, if you are then no 80GG. I guess I've answered all the questions, but some of you have said I've not answered. Just give me a minute. I'm just checking the question whether I've covered. Okay, this is about the last question, last session about, I guess it is about calculation of interest. I don't remember it exactly. I'll just tell you. If it is for the whole year, that is if the loan has been granted on 1st April itself, the interest is for whole year. So you don't calculate months. If the interest of loan, that is for 80, if I'm right, it should be for 80 EEB, the electric vehicle. If the loan is provided on 1st April, the loan interest is for the whole period, 12 months. If the loan is in between the period, let's say the loan was provided in 1st July, you only calculate for 9 months. So that's the reason. So why I have calculated in months for one person and not in months for other person? For the person whom I am calculated in months would be only for the part of the month. So that should be the reason. Probably you can go back to the question and see that. Okay. If there is any question that I have not answered, probably you can just repost the question so that I'll see. I guess I've answered all the questions. The 30% is eligible for all the 3 years. So that's it. So probably we'll move on to the next next section. Next session, as we said, is on income from other sources. That is, you have 80 TTA and 80 TTB. 2 sections is what we are going to cover here. Both are related to interest income. TTA is savings bank interest. TTB is for senior citizens interest income. So we'll first see TTA. You have a savings bank account. You are an individual. You have a savings bank account in bank, cooperative society, or a post office. Up to 10,000. If you have a savings bank interest, it is eligible. If more than 10,000, 10,000 is eligible. So it is whichever is lower, your actual interest, or we can keep it this way, your actual interest or 10,000, whichever is lower. So whichever is lower is what you need to consider. That is the deduction. What about 80 TTB? It is for senior citizen. In case of senior citizen, they can claim up to 50,000. In deposits. The word here is deposits, including time, which means your fixed deposit, your recurring deposit, or any deposit with banking company, cooperative society, post office. Up to 50,000, it is exempt. So in case here also, what is the procedure? It is actual interest or 50,000, whichever is lower. So that's what the provision is. If the account is held by or on behalf of a firm, so in case if it is actually belonging to AOP or BOI, no income shall be allowed in the hands of partner or member who will compute in their income. So which means if AOP or BOI have already claimed that 80 TTA benefit, member cannot claim it again. So that's the interest. So if you actually see this AOP BOA is similar to what we discussed in clubbing, right? Not clubbing. In your other deductions that we spoke about, ATC and all, if the benefit deduction has already been claimed by the AOP BOA, the member is not supposed to claim. So basically, the deduction is eligible only for one person. If the AOP BOA has claimed, member cannot claim. If they have not claimed, member can claim. That's all. So if it's an account held by on behalf of a firm of an AOP or BOA, that is an individual is holding, but on behalf of the AOP. In that case, no income shall be allowed in the hands of the partner or member. It shall only be allowed in the hands of the AOP BOA. So that's the thing. So typically, that's about the last one deduction that we'll be covering is ATU. Eligible assessee, that is who's a resident. We'll ignore this word. Who's a resident and disabled. So he is a resident and he is disabled. In that case, if he is getting medical treatment, training, or rehabilitation, or it includes autism, cerebral palsy, or multiple any disabilities, paid into the scheme of we'll ignore this also because this is all. What the reason is, 80 DD and 80 U are same. Okay. Just that this is for dependent. This is for dependent who is disabled. 80 U is for self who is disabled. So here the concept of dependent does not come. So that's why I'm just removing anything related to dependent. 80 DD and 80 U are same. You need not remember it separately. Just that anything related to dependent must be striked off. That's all. Nothing else changes between 80 DD and 80 U. You must obtain a certificate. And if you have disability over 80%, it is 1,25,000. Otherwise, it is 75,000. Nothing changes between 80 DD and 80 U, but for something related to dependent. So if there is any provision in 80D that we have discussed about dependent, we can remove that. So this is not for dependent. So anything paid for dependent is not considered. So anything paid for self, whatever is being relating to treatment costs or another, it's a flat deduction. It's a flat deduction. Both 80DD and 80U are flat deductions. So it is 1,25,000 or 75,000. Doesn't matter what was the actual expenditure. Okay, so we'll move on to a detailed exercise problem and then understand few MCQs, and that is the end of this chapter 6A. So we'll see this exercise problem. We'll go through the question. Gurnam is aged 42 years. He has salary income. See the word computed. What should you do if the word computed is? Just take as it is. What if the word computed is not given in your provision? Reduce standard deduction. Reduce standard deduction. So for the previous year ended 31/3/2022. He has also earned interest income of 14,400 on savings bank account. What account? Savings bank account. What section do you remember? 80TTA. 80TTA with State Bank of India during the year. Compute the total income of Mr. Gurnam. Just a second. If it is senior citizen, even savings bank is covered under 80TTB only. So once you see it is a senior citizen, what is eligible is 80TTB, which includes savings bank and FD interest, RD interest, all other interest. For other than senior citizen, less than 60 years old people, what is included is only savings bank. So if it is not senior citizen, since he is less than 60 years, provision applicable is 80TTA. So 14,500, how much is exempt? 10,000 with State Bank of India. Assume 115 BAC is not opted. So he has paid LIC. As I told you, it says paid in cash. It says paid in cash for dependent parents. Confusing or extra information we need to see, right? Out of these two words, one is confusing, one is extra information. Cash is confusing. LIC paid by cash is allowed. Doesn't matter. It can be paid by cash. But LIC is only allowed for self, spouse, children. It is not allowed for parents. 80D only is allowed for parents. Compare 80C and 80D for the list of eligible people so that you will remember it better. I'm using this word compare between provisions quite frequently because when you compare, you remember it better. We compared 80GG, HRA. We are comparing 80C and 80D. So compare to understand the provisions better. So dependent parent. So this is not eligible. So this is not eligible because it is for parents. So this has to come in a note. Life insurance premium of 25,500 paid for the insurance of life of his major son. What is this word? Is it confusing or extra information? 80C, son is allowed, doesn't matter whether they are major or minor. So it is confusing. Who's not dependent on, another confusing word. Should be a dependent or not dependent. So 80D only says dependent child. 80C does not say dependent child. The sum assured, extra information, 3312. So we are always discussing about extra info, confusing info. Right? So we need to understand both in every problem. And the life insurance policy was taken on 33. And next is life insurance paid by check, confusing, not relevant. For insurance office life, relevant. Insurance policy was taken on 8/9/2017 and the sum assured is 2 lakhs. So these are the information. So all these are 80C, right? So we'll just write here 80C. This is also 80C. Paid by check for health insurance. Paid by check. It is mandatory. For 80D, it is mandatory that it must be paid by check. Only thing allowed in cash is self-health checkup. Only that health checkup is allowed in cash. That 5,000 is only allowed. Otherwise, it is not allowed. Premium of 26,000 for self and his wife. So this comes under 80D. 1,500 paid by cash for his health checkup. It is allowed, right? Because health checkup can be paid by check, cash also. 4,000 paid by check for preventive health checkup for parents. 80D allows for parents also. So health checkup for senior citizen is also allowed. So they are senior citizen. So this is also 80D. Paid interest of 6,500 for MBA course, 80E. Okay. Sum of 5,000 donated cash to an institution for family planning, 80G. Right. So these are the things. So you have how many 80C? Two 80Cs. So we'll first calculate the problem. So what do you do? Particulars, amount, note. By default, you should come out with these lines so that this columns, so that you actually know what you are actually writing. You maintain a format template. You don't confuse how to represent a problem. Okay. So now what do? I take the total income, that is salary. Salary is 5.5 lakhs. Salary is computed. So I take as it is. IFOs, interest income, 14,500. It is only a deduction. So include income above and only then you claim deduction. What is the difference between exemption and deduction? Exemption does not form above. When you say interest income, you must remember you should include it in the income. You should not write 4,500 here. It is 14,500 here. And finally, you'll have to give deduction under 80TTA as how much? 10,000. So your gross total income, gross total income is 5,64,500. Now less Chapter 6A deductions. Chapter 6A deductions. So what is first? 80C. So what are there in 80C? Okay, we'll have to write LIC dependent parent. Note 1 nil. That makes sense, right? Valuer will now know, okay, they have read the question properly. They know that it is not eligible for dependent parent. So they know that you have understood the provision. Give that impact to the valuer. Give the impact to the valuer that you have understood the provision. That's what makes the difference in scoring marks. Next one is life insurance premium of major son, right? So that is eligible. So LIC major son. So what is the total thing? It is 2,50,000 is the sum assured. Before 31st March 2012, it was 20%, right? So they are eligible up to 50,000. So whatever was paid, only 25,500. So it can just be considered as it is. You can actually write a note for this also, saying that since the policy was taken before 31st March on or before 31st March 2012, the maximum premium allowed is 20% of sum assured. Since the premium paid of 25,500 is less than the 20%, it is considered. So this again, what I am saying, it provides the valuer that you have understood the provision. Major son is 25,500. And then you have what? Life insurance paid by for his own life. So that is self. So self is, I'm sorry, I did not see the amount. Self is 22,500. Sum assured is 2 lakhs. So in this case, how much is allowed? Only 20,000, because 2 lakh into 10%. You can write that also as a note. What is actually eligible is 2 lakh into 10%. So that is only allowed. So anything above is not allowed. So that is LIC, right? So is there any other LIC? You have written this, you have considered this, you have considered this. Yeah, that's it. So that's all about ATC. So how much is ATC? It is 45,500. Is there any other ATC? Nothing, right? So probably we can take it to the next column itself. So I'll write 45,500 here. Then we have 80D. 80D. 80D is self. Self for what? Self premium. Premium health checkup. Then parent health checkup. So this is what was provided, right? So premium for self and spouse is 26,000. Write a note here, that is 26,000. Health checkup. Health checkup is 1,500. Then health checkup for parent is, so this is 29,500. But what is allowed is only what? 25,000. Health checkup for parent is straight away 4,500. If you want, you can put a note under 80D, note 4. Work out in note 4 this premium. Bring out and write just one number, 29,500. So how did you arrive this 29,500 will be there in the note. So this is also allowed. So now this is totally it is, sorry, this is 27,500. 27,500 restricted to 25. Health checkup for senior citizen. So additionally allowed for parents, it is 4,500. Then what else you have? 80E. 80E is 6,000, right? 6,500. Then 80G. Family planning. Okay. So and then you have net total income. Okay. So how much is for family planning? For family planning, we'll have to calculate this adjusted gross total income, right? So what will be the adjusted gross total income? 564,500 minus 45,500 minus your 25,000, 4,500 and 6,500. All this you have to minus. Let's take how much? 70, 74, 75, around 81,000. So I'm just trying to do it roughly. So probably we'll calculate. Adjusted gross total income is basically how much? 564,500 minus 45,500 minus 25,000 minus 4,500 minus 6,500. So is equal to 5,64,500 minus how much? 7,500, 75, 81,500. So that will be what? 4,83,000. I'm not sure. You can just rework and see. So 4,83,000 into 10% is 48,300. However, the donation is paid is only what? 5,000. The sum of donated in what? In cash. Should we calculate adjusted gross total income for this? Not at all required, because if it is in cash, whatever we have done here is only excess time. It is not required because the word says it is in cash. So moment it is in cash, it is not allowed, because anything above 2,000 is not allowed in cash. So this 5,000 is nil. So what note number? Note number 5. You write that anything above 2,000 from 1st June to 2020 is not allowed is not allowed as a deduction. So now what is the net total income? Anyway, the working has helped us here to understand 4,83,000, right? So the net total income is 4,83,000. So that will be on what have they asked you to compute tax? No, only the total income. So the total income is 4,83,000. Clear? So we'll move on to the MCQs. Yeah, I'll answer some of the questions. See, Namrata, the one thing that is 80 CCD is Atal Pension Yojana, that is National Pension Scheme. There you have two categories. So in 80 CCD, you have section 1, subsection 1B and subsection 2. This is part of 80 CCE. So that is within the limit of 80 CCE. 1B is where you get plus 50,000, that is additional 50,000. 80 subsection 2 is additional, that is 14% of salary or 10% of 10% of salary depending upon the employer. So the contribution by employer, this is for central government, this is for others. So this is 80 CCD2. So whatever that you are talking here is 80 CCD2 is eligible for additional deduction. Yes, it is eligible. And the limit is salary is 14% of salary for central government employee, 10% in case of other employees. Yeah, Jamil, I guess it was 30th September 22 only. By mistake, only I've written 23. So the date year of 80 QQB, right? It is 22. So yeah, so you're right. So it is 22. Jamil, for 80D, for parents, medical insurance is allowed up to 25,000 normal person, 50,000 for senior citizen. That includes a health checkup up to 5,000. So if they have spent 4,500 for parents, that is an eligible deduction. So that's why I've taken this 80D for parents. So 80D provision says for self it is 25,000, for parent it is 25,000. If senior citizen, self is a senior citizen, 50,000. Parent is a senior citizen, 50,000. So this is 80D provision. Probably when you're refreshing 80D provision, you'll try to understand. So the health checkup of 4,500 is allowed. Health checkup increases to 6,000 80D only. Yeah, health checkup 5,000 for self, 5,000 for parent. It's actually 5,000 for each. Self 5,000, parent 5,000. It was 1,500 for self, 4,500 for parent. So we have considered it separately. So this is for self, right? So this is separately, this is separately. So whatever we are considering here, this is separately and this is separately. So 5,000 each. So that's how the provision goes. Okay. So what are the other questions? Yeah. Prema, the son's policy was on 31st March 2012. The policy was on 30th March 2012, right? So in that period, the maximum premium allowed is 20%. So that's why we are allowing it. So that's why we are not applying 10%. 80D, it's not allowed. 80G is not allowed. 80GG B, 80GGC is not allowed. So these are the sections, preferably where your cash payments are not allowed. It must be mandatorily through electronic payments mode. And also in 80JJA, we said emoluments must be in bank, must be through bank. It's not allowed in cash. So I guess these are the sections where it talks about cash payments. Other than that, I think it is not there. Yeah, Nitin, sorry, I guess I missed out. I missed out the 80 TTA deductions. 80 TTA savings bank. So it's 10,000. So this will be 4,73,000. I'm sorry for that. Yes, Nitin. So it must be deducted. Again, going back to the earlier session, see the interest has to be calculated from the disbursement date. Interest must be calculated from the disbursement date, not from the sanction date. For provision, we'll have to calculate sanction date. For disbursement, we'll have to calculate it only from the disbursement date, whatever the date is disbursed. Anirudh, so basically the 80C and 80D, the differentiate between insurance and insurance paid in 80C and 80D. 80C is life, 80D is medical. So 80C is life, 80C is life, 80D is medical, that is health. Maximum health checkup is 5,000. Whatever you spend, 5,000 for spell, 5,000 for parent, but it is within the limit of 25,000 and 50,000. ATC revision, probably I'll try to do in some other session when I have time. It's already 9:30. I have few more main CQs also. Yeah, for calculating adjusted gross total income, 80 TTA also should be reduced. But by mistake, I had actually not considered 80 TA. Anyways, I've corrected now. In our working, 80 G is not required because the donation was paid in cash. So I have corrected that mistake of mine. Yeah, I guess I've answered the question. So we'll move on to the last five, just multiple choice questions to have a better grip on the question one. So resident individual. So he's a resident, aged 61. To be a senior citizen, you have to be a resident. Only then you're a senior citizen. It's not just 60 years. It is a resident who is more than 60 years old. He has earned business income, computed that is 1,35,000, 1,20,000 of lottery income. He also has an interest on fixed deposit of 30,000 with banks. So now he invested an amount of 1.5 lakhs in public provident fund. What is the total income of assessment year 22-23? This is slightly tricky question. Probably I'll try to tell you. There are some sections in which Chapter 6A deductions are not allowed. Chapter 6A deductions are not allowed. One such provision is lottery income. So you cannot claim Chapter 6A deductions for this special income, casual income. Lottery, crossword, puzzle, in that income, you cannot claim Chapter 6A deductions. So typically that's the question here. So my income, my total income will be how much? 1,35,000 plus 1,20,000 plus 30,000. Correct? So it will be 255, 2,85,000. Now for deductions, I am eligible for 80C 1.5 lakhs. 80 TTB, I am eligible for 30,000. But the maximum deduction I can go only on this particular income and this income. This is not allowed. So my maximum deduction under Chapter 6A can only be 1,65,000. So this will get restricted to 1,35,000. So I'll probably work it itself. So you have an income, let's say business is 1,35,000. Lottery is 1,20,000, right? 20,000. And then you add what? Interest, 30,000. So this is 2,85,000. Now, less 80C. That is, I can only claim on these two. I cannot claim on anything else. So my what you call my benefit whatever I'm talking will only be on this particular portion. This particular portion only is eligible for deductions. I cannot claim deduction in that lottery income. So what happens here is I will claim 1,50,000 on PPF, but 80 TTB I can only claim the balance, that is 15,000, because I'm not allowed to claim on the balance. So my total income will be 1,20,000. So the point of this MCQ is Chapter 6A deductions are not eligible on casual income The answer here will be 1,20,000 because Chapter 6A deductions are not eligible on lottery income. Gross total income is 8 lakhs. She donates 50,000 for promoting Olympic sports and 1 lakh for approved charitable organization. So they have paid 1,50,000. So what will be the total qualifying limit? It will be 80,000, right? So in 80,000, first preference is to 100%. So you give this entire 50,000, right? And then you do 50%, where you are only eligible to do what? You can't claim this 1 lakh. You are only restricted to 30,000. That is what? 80,000 minus 50,000. So that is how you calculate this 80,000. So this into 50%. It's just 15,000. So total ATG will be 65,000. Clear? So the total deduction eligible will only be 65,000 because first you take 100% qualifying limit, you give the whole 50,000. For the balance, only 30,000 is eligible. So in 1 lakh, what is allowed is only 30,000. So this 30,000, you apply 15% on this 30,000. So that is how you get this 15,000. So that is how that 50,000 plus 15,000 becomes 65,000. So the answer will be what? 65,000. So the answer will be 65,000 from what you are talking as particular thing. So that is about the next thing. Question number 9. Question number 9 is basically C has made a donation of 10,000 and 5,000 to a university promoting scientific research on 30th May 21 and 4th June 2021. How much deduction can be claimed by under ATGGA? Now, he has paid the donation by cash. So, how much is only allowed? Only 2,000 is allowed. So, this 10,000 is also not allowed. This 5,000 is also not allowed. So, MCQ, which is last question number 10. C runs a footwear business. They have recruited 100 regular employees from 1st March 2021. So, they are able to work only 30 days. We said 150 days for footwear business, but they are able to work only 30 days. So that is not their mistake. So it will be eligible in the next year. If they work for more than 150 days in the next year, this employees can be treated there. So with salary of 15,000 per month, 20 employees quit on 30th June 2021, which means they have worked only 3 months. 3 months in the subsequent year, which means it's less than 150 days. So you take them away, they are not eligible. So the other 80 employees work till 31st March 2022. Some of you have questioned this. What about in the subsequent year? So in the subsequent year, they should have worked 150 days or 240 days or more than that. So that's what you do. So what happens now is this particular employee, that is, it is eligible only for 80 employees because only 80 employees have worked more than 150 days in the subsequent year. So 80 employees into the salary becomes very critical. It is only 1 month because only March 21 should be considered. We are calculating only for March 21, that is financial year 2021. Only that is the deduction is provided in the next year because of the provisions. So now 80 into 15,000 into 1 will be the eligibility. How much will be the eligibility? That is 12 lakhs, right? 15 into 8 is 120, 1,200, 12,000, 1 lakh, 12 lakhs. 12 lakhs into 30%, that is 3,60,000. So as far as 80 JJAA goes, you should only calculate for the month in which for the period for which they were new employees in that year. Even though the provision is allowed in the next year, you should only consider that first year's period. So that's the critical thing. In our earlier example also, we calculated from September 2020 to 31st March 2021 only. So that's how you need to do. So what will be the answer? 3,60,000. Right? So with that, we will wind up today's session. I'll just see if there is some critical question that you need to answer alone. I'll try preparing a summary of this cash, parents, dependent and all so that I'll see if it could help you. I'll see that if I can upload it as a note. Yeah, for calculation of adjusted income, 80 TTA also have to be considered. Non-relative senior citizen is not allowed. 80D only specifies self and parents, self, spouse, children and parents. Children must be dependent. Parent doesn't matter whether they are dependent or not. For LTCG and STCG, deductions cannot be claimed by non-residents. So that 112A and 111A, the basic exemption limit and Chapter 6A. The basic exemption limit is not available for anyone. For 111A and 112A alone, Chapter 6A cannot be claimed. So anyways, I'll try giving a summary of those also. See, the new employees, let's keep it this way. You should work for more than 240 days to claim it in a particular year. So now, let's say a particular person was employed on 1st May 2021. So till 31 March 2022, if he has been working, he has worked for more than 240 days, right? So for this employee, deduction under 80JJ will be available in previous year 21-22. Okay, this is the first category. Now let's take the employee was employed on 1st September 21 till 31st March 2022. He is working. Here he is employed for less than 240 days. For why has he been working less than for 240 days? He has worked less than 240 days because he is recruited less than 240 days. He is not able to work more than 240 days. In that case, check next year. Check previous year 2022-23. Check 240 days, the same criteria. Check 240 days. If he satisfied this, if he has satisfied these condition, then provide deduction in previous year 2022-23, but calculate for numbers, for values in previous year 21-22. It is just allowed in the next year, but the calculation is based on the previous year only. Now, for 22-23, for previous year 22-23, such employees are not new employees. not new joinees. They are not new joinees for the subsequent year because you have already considered them as new joinee in this particular period, right? So it is not new joinee. So that's what is about the 80JJA. So I suppose I've explained it very clearly. In case not, probably you can just see the video or the refresh it again, probably see whether you are able to understand it. So with that, I will wind up today's session. So thank you all for the wonderful session. Thank you. Yeah, it is concluded. Thanks a lot.